Good morning, everybody, or good afternoon by a couple minutes. I'm Ryan House, who most of you know. Josh Frazier, to my left, is our CDO and Chief Investment Officer. Josh, what are we talking about today?
AI. So AI will eliminate 40% of the jobs that exist. AI is the most important technological advancement in the history of humankind. Those are some of the outlandish statements you may hear. Stephanie is joining us today from JP Morgan. We're going to talk a lot about the investment implications of AI, the build out, the data centers, energy usage, medical technology. So much of today's discussion is going to be around how is this impacting the investment world? And we're excited to have Stephanie join us. If you have some very philosophical questions about AI being good or bad, we could save those at the end. Maybe Stephanie will opine on that, but I think she loves talking about the investment implications, first of all. So Brian, I'll kick it back to you and introduce Stephanie.
Thanks, Josh. So Stephanie is with JP Morgan, who everybody is familiar with. She's on a team with one of our favorite economists, Dr. David Kelly. A lot of you have heard us reference him before, and we follow closely what her and Dr. Kelly's team are doing. So I will not embarrass her by reading this long bio. Stephanie's based in New York, is very much an expert on the topic. And Stephanie, thanks for being here. We're really excited to have you share.
Well, thanks for having me. It is a treat myself as well. Shall I go ahead and kick things off?
Yes, please. I'll stop sharing here. You can take over.
Wonderful. Thanks so much. Happy Friday, everyone. And oh, sorry, I will need sharing turned on for me. And then go ahead. But maybe get the tech set up. We could bring the slides up a little more. Or I'll just give my intro. We'll go that way. Anyway, Stephanie Aliaga from the Global Market Insights Strategy Team at JP Morgan Asset Management. And for the better part of the last 3 years, I've focused specifically on AI. What we're seeing in terms of the advancement of the technology, how AI is impacting the economy, what impacts may come. We heard that outlandish statement about, the impact to the labor market, 40% of jobs displaced. I don't know about that, but I'll try to add some clarity around what we are seeing in real time as it pertains to AI in the labor market, as well as AI and the financial markets. In fact, Michael Sembalist, a strategist from our firm, put together the math on the impact that AI stocks have had on the market. And if you go back to the launch of ChatGPT in late 2022, since then, AI stocks, linked stocks, have accounted for 75% of all of the returns in the market. They've also accounted for 80% of all of the earnings growth and 90% of all of the growth in capital spending. Because as we've seen, and we're seeing nearly every week now, there is another major capital spending commitment or announcement from some of these mega cap tech companies around this AI wave. So what is it about AI that is so expensive? Is AI going to live up to the hype? And where are we? What inning are we in? That's the question that everyone keeps coming around to. Are things fully priced? So a lot that we can tackle into. And now that I can share my screen, wonderful. Let's go ahead and do that. So first, I want to cover where we are in the advancement of AI, because I know it seems like AI is everywhere already, and ChatGPT served as this kind of light bulb moment for the markets and for many of us around how advanced AI models had become. AI is no new phenomenon, right? We've been writing books and movies and singing songs about this concept of machine intelligence matching or even beating human intelligence. But what happened in recent years are a few things. With the advent, particularly of generative AI, which really goes back to like 2017 with the creation of the transformer from Google. So you can see on this page, we suddenly got a lot better at training these models to do things that humans do relatively intuitively, right? After a certain age, they can understand someone's handwriting, understand speech, images, reading, language. And with generative AI, AI models can now create And just via interacting with one via language, you can now create poems, write books, images, create music even. So that was a significant shift when it comes to the advancement of AI. And where we are today is this new era, I'll say. Generative AI is still very important, but now agentic AI is becoming even more so. So agentic AI is now not only AI models that can create new content, but they can act autonomously. They can synthesize information, problem solve, and then execute. And the ability for AI models to do that is really owed to progress in this red line here, predictive reasoning. Now, one of the biggest innovations that have happened when it comes to training these models has been reasoning inference. With reasoning, models now, when they're look at when you send them one of your queries, they're developing a plan of action. They are breaking it out via steps. And they may actually answer your question many different times. And then they're going to iteratively check which answer is most robust, most precise. They're going to attribute links and sources and so forth. And through that inference process, they can tackle much more complex tasks. We are dealing with fewer, not perfect, but fewer hallucinations. It may take them a little bit longer to get a response to you, but we've opened this door to AI models that can now potentially, right, help us book a restaurant reservation, that can help us browse, that can go and man a car through city traffic in a city it's never been in. So agentic AI is this major shift. It's been a huge focus now for companies too. And it also begs the question, okay, we can test these AI models in these kind of exams and via different benchmarks, which is what this slide shows. But what's going to be most important going forward is AI that is useful, that actually takes work off of our plates. So in that regards, I love to use research done by this group called METR, where on an ongoing basis, they have been testing each of these general purpose large language models that have been released to the public over the last many years. So GPT 3.5 in around late 2022, that was the ChatGPT that was first launched to the public. And then since then, we've had all of these different upgrades. It's also not just been ChatGPT. It's also been Claude, a model by Anthropic. You've had Gemini, Grok, which is from XAI, DeepSeek, the Chinese model. So all of these different examples. And what they find is, okay, the length of tasks, and by length, we're talking about how long it takes humans to do them. So tasks that take us longer to do are typically more complex in nature, right? So the length of tasks that AI agents can now autonomously complete at an 80% success rate. So it's not 100%, but 80% is pretty decent. That has been doubling every 7 months. You have this Moore's law here for the task, the length of task completion. Now that's impressive. It begs the question of what this looks like in the next year, 2 years, 3 years, as we get better and better at training these models. But what's also important here is the values here on the y-axis. Okay, so GPT-5, the latest state-of-the-art model from OpenAI, pretty neat. I now use it nearly on a daily basis, that's for sure. And it can autonomously complete tasks that take humans 26 minutes to do. Now that's useful, but that's not automating most workers 9 to 5 anytime soon. So the argument that I'm going to make for you on the labor displacement front is that AI is simply not there yet. And while the intelligence has increased significantly, and we are getting better at AI agents that can help us with actual tasks on our plates, get at that critical threshold where automate a large swath of work in this economy. That doesn't mean that this isn't already a game changer. Now companies are looking at this and they're wondering, okay, can I scale this? Maybe instead of, because most companies aren't just using a general purpose model, can I train a model to do specifically one task or a few tasks? And there, maybe instead of 80%, I can get to 90%, 99%. Maybe I can get a team of AI agents working together, each with their own specialty. And there, I think, is really the potential unlock for productivity gains for companies. So that is really characterizing the focus on agentic AI on the enterprise layer. It's not just using these general purpose LLMs, but really developing more customized AI agents. But the reality is that takes time and it takes a lot of human oversight. And if in some aspects, some domains, AI is at risk of getting things wrong, I mean, that can create a lot of hurdles for companies to be mindful of. So I have a great story on radiology that I'll save for maybe later in this presentation or in the Q&A. But let's just move along here and talk about what is really helping fuel adoption around AI. And there, I think talking about the economics of all of this is really important. So how much is AI going to cost? How much does it currently cost? Well, I'll start with the good news. The good news is the cost of using these models has been coming down expeditiously. So if you look at this chart, it's on a log scale. So that means the magnitude of the decline is tightened up a little bit. But if you look at the labels here, it used to cost $20 to feed 1 million words or tokens into these AI models. And now it only costs a few cents on the dollar. A significant plunge in the cost of using AI. Now, you might think, okay, so if we're getting so much more efficient at using AI, then why do we need all these infrastructure investments? Well, what we've seen is this concept called Jevons paradox, which essentially explains the phenomenon where when you get more efficient at using something, instead of needing less of it, you end up needing more of it because efficiency gains then accelerate the adoption of it, the usage of it. And that's what we're seeing right now with AI. While we've really lowered the cost of inference, you've also enabled a really fast pace of adoption from these technologies. And we're using these models for more. We're giving them harder questions, and we're increasingly trying to bring them into the real world. And we're not really there yet in mass. Like physical AI is really still quite nascent. But as we do that, and we give them harder things to do, what happens is these models, they stay in inference for longer. They're thinking for longer because we're giving them harder things to do. And that thinking process can require a lot more compute. In fact, NVIDIA estimates that with reasoning inference, we're going to need upwards of 100 times more compute relative to single shot inference. So where we're at right now is this really fascinating moment in time where compute is becoming the world's most critical resource. And to use AI in the ways that we can envision that we're planning to, and to extract the value from that over these next few years, we're going to need to get our hands on compute. It's not only to use AI, it's also to train AI models, because the reality is GPT-5, that's that latest, state of the art, but OpenAI is not done yet. Neither are its competitors training models. You have all of these different companies training models, trying to get to super intelligence, trying to push that frontier of intelligence. And each time they do that, they are spending 2 to 3 times more than the previous iteration on training these models. So not only on the compute, also on the human capital front, turns out it's a pretty lucrative career right now to be an AI scientist. They're getting traded from company to company like they're NBA all-star players right now. But we're still in the early innings of this. And I will say, and the story around compute is something we'll come back to in a moment here. But let's just talk about adoption. I mentioned that adoption is accelerating pretty remarkably. And when you look at the left-hand side, this is some research done by the Federal Reserve Bank of St. Louis using 2024 data, showing that last year you already had 40% of working age adults using generative AI at home or at work. And they modeled that that was twice as fast as what the internet saw. Now, I will say that is probably the low end of the range. Stanford came out with an estimate of adoption upwards of 70%, but only 40% of people actually consciously recognizing they're using AI when they're using AI. And that really just underscoring the fact that AI has already become integrated in a lot of consumer facing applications. I'm sure many of you use it right now. In fact, we were just talking about the beautify filter on Zoom before this, and a lot of those filters are AI enabled, right? But you may not be thinking about that at the end of the day when you're like, did I use AI today? So there's all of these different ways that it's already kind of become apparent. And part of the reason why the uptake has been so historically fast is also because the skill barrier here is quite low. You don't necessarily need to take a computer class like you did when you were trying to get familiar with using the laptops and computers at one point. Right? You don't need to take a computer class. It just understands your English. And my mom, immigrant from Peru, it even understands her imperfect English quite well, I might add. So I think that is just one testament to why the consumer uptake has been so unprecedented. But also, when we just think about business adoption, because business adoption is really important here. When we get to in a moment here, the mega cap tech companies that are spending all of this money on AI, their core business model is in providing AI services. And who's going to pay for those? Consumers are paying for them to a degree, especially all those, if you pay for a pro subscription to ChatGPT or whatever LLM that you like using, you're a paying user of AI. But the real big bucks, the real market opportunity here for these hyperscalers is business adoption. Now, the right-hand side shows how business adoption has been tracking. And as of August, you had 10% of US firms saying that they're using AI to produce goods and services in their production process. Now, this is an imperfect measure. In fact, if you look at the companies that have paid subscriptions to AI models, so they're paying for some kind of AI use case right now, that number is actually 45%. And what is so fascinating about this chart is how wide this gap has gotten, and that the real accelerant happened this year. I mean, this is where when people say we are still so early in this AI wave, that's what we're talking about. So companies may not be saying, yes, we've integrated AI, but they're actively figuring out how they do so. And we're in this really fascinating moment in time where some companies are leading ahead, some are lagging, and the ones that ultimately bear the most fruit out of all of this will be characterized by their speed, by their ingenuity, by the actual agentic AI workflows they create, their focus on worker retraining, which has been a huge focus for the vast majority of firms that are using and spending and investing in AI models, and their ability to ultimately enhance the customer value proposition by using AI to improve the quality of the goods and services that they ultimately sell. So a lot underneath the hood here that's changing. And on the right-hand side, I mean, you can see how some of the more digitally native sectors are leading ahead here. But it's also not just tech. You also have finance, education, manufacturing, even retail to a degree, increasingly paying for AI subscriptions and figuring out how they use this. And one of the big questions that I think this really creates for active managers, is, okay, we've gotten really familiar with tech having and boasting greater profit margins than the rest of the index. But could we begin to see that change, particularly as a broader set of professional services now become tech enabled, AI enabled? And there could be a real opportunity here for productivity gains to span beyond just your tech native sectors. So a lot of really interesting stuff underneath the hood here. But ultimately, we do expect that AI adoption will scale. We will get to mass adoption. It might happen quicker than what we've seen historically. And as economists, as market strategists, and as long-term decision makers here, there is this real potential for a productivity upswing. And this is going to be really important when thinking about what is that long-term outlook for the US economy and that long-term outlook for US equities and margin expansion and the continued justification of elevated valuations. It's hinging really in many ways on this productivity potential. Now, what this chart shows is our long-term history of productivity booms and busts. And it also highlights different moments of tech disruption. And these dashed lines show when different transformative technologies were created. And the reason we add this here is to really make the point that there's a lot of uncertainty here when it comes to the timing of a productivity upswing. It sometimes can be due to more cyclical or geopolitical factors like us getting out of a world war, getting out of the Great Depression, versus us adopting a technology at large. Now, ultimately, we do think the technology fruits do contribute to the productivity upswing, but it can be a tricky thing to time here. In history, over history, it's taken like 15 to 20 years before productivity materialized. This time could be faster, but there's a question there. And then also the magnitude is a big question here too. We do think there is a lot of potential here for AI to be quite productivity enhancing. We've never had a technology that has the ability to automate or improve such a wide swath of tasks that make up this economy. But there are also a lot of productivity offsets. This economy is, we've increasingly shown a preference towards leisure. Maybe we just spend less days, less hours at work. We get that 4-day work week finally. That could be a little bit of an offset to productivity. It could be that we hope and we do expect AI will create a whole lot of new jobs in new sectors and new industries for humans to work in, and for us to elevate in the work that we do and shift towards more human-oriented uses of our time. But if it doesn't, that'll also dampen some of the productivity gain here. So there's some uncertainty, but I will say it is, even this year, providing a pretty important boost to the economy. And it's something that is going to be increasingly important going forward, given the fact that we do face an aging population. Immigration has swung very restrictive. We're going to need productivity to be that 2% economy that we are. Now, before we even get to that productivity pot of gold, we need to make sure we have the right infrastructure. We need to make sure we have the right resources here to use AI to the degree that we envision that we will. In order to get there, you have these mega cap tech companies quickly, expeditiously accelerating their capital expenditures. Last year, they accelerated those expenditures 67% on an annual basis. And this year again, 64%. And it's not just these companies that I'm showing here on this page. Beyond that, you also have sovereign AI buildouts. Countries globally are investing significantly in their own domestic AI infrastructures. You also have other cloud players entering the arena here. Companies like Oracle, like CoreWeave, Apple to a degree, are investing in their own cloud services. And as you've seen in some of these headlines, these numbers are pretty eye-popping. Hundreds of billions, even trillions of dollars in CapEx. In fact, we do expect by the end of 2023, by the end of this decade, we might meet or surpass $1 trillion in annual CapEx globally. So, okay, these numbers can feel sometimes like the pie in the sky. Are we just throwing money at this and getting rewarded by investors because of our ability and conviction in investing in AI? I mean, what is the ROI on all of this going to look like? And are we in a bubble? Those are the big questions really circulating the news wavelengths and CNBC and investor dialogues right now. And there's a few things I really think are important in this debate. First, and it's what we show on the page, the vast majority of this spending is financed by the cash flows of already really profitable tech companies. And that is something that we've really never seen before in history. And we've had periods of capital spending booms and busts. And what is unique about this is that financing of it, and also the resiliency that that gives this capital spending boom. Because if you look back at these other bubbles that we've had, and I'm not saying AI is a bubble, but let's just look at the other bubbles that we've had. What really causes these bubbles to break is a credit freeze, a credit front crunch. The Fed suddenly hiking interest rates, tightening monetary policy, and companies being unable to refinance this debt at higher rates. And and what is so different about this time around is, yes, we are beginning to tap into debt markets. You have some of these companies either tapping into public debt markets or private credit markets, but the vast majority of the spending financed by cash. And even after all of that spending, they're still free cash flow positive. In 2025, capital spending is only accounting for a little more than 60% of their operating cash flows. So that is really important here. Beyond that, the spenders here are really high quality companies with some of the strongest earnings growth in the market. A company like Microsoft, for instance, has a better credit rating than the US government right now. So you have issuance and spending by really high quality companies that is also really important here. And then beyond that, we're not seeing spending, even though it's accelerating quite quickly, it's grounded in an acceleration in the need for compute. I've just talked about how 100 times more compute being needed for inference. And we're not yet at the critical threshold of inference that we're all going to be using. I'd love to do a tally on the call here, how many people use AI daily. I'm sure a good amount of you will say yes now. But when we start talking about the usage and the depth of AI that we're using, like, we're not yet at AI in the physical world yet. And that's going to be a real game changer. So the moment in time that we're in right now is companies trying to plan for the future. And to plan for the future, they know they're going to need resources in the future. So they're acting now with resources they expect to have in the future to ultimately get there. And that's the kind of ingenuity behind a lot of these commitments. Now, the circular nature of some of this is unsettling in some ways. It conjures up, these memories of what we saw in the dot-com era. And I'm not saying that some of these deals will not be good ones or spell some trouble. But as a share of the overall market of CapEx, these deals, for instance, the one that we saw with AMD, the one that we saw with NVIDIA, 100 billion, 200 billion, sounds like a lot. But the entire market of CapEx that we're looking here is in the trillions. So it's not the core, I guess, share of all of the spending that we're looking at. And most of that still seems to be grounded in pretty healthy fundamentals. So those are some of my few cents on the bubble conversation. I just think it's so important to kind of talk about that right now. But when it comes to, okay, what do we do as investors? And there are uncertainties around this AI spending spree. And I will say, look, capital spending booms have time and time again seen the misallocation of resources. And there's absolutely a risk that we do have some misallocation. We don't know exactly how the math is all going to tie out. And to hedge against some of that, we think looking at the recipients of capital spending is also really important. And we think there are a lot of opportunities there. And these are companies that are not in your tech sector, right? So let's just talk about the energy landscape here, because energy is going to be one of the most important resources here and one of the potential bottlenecks to getting to that AI future that we are propelling towards. If you look at this page, on the left-hand side, I show electricity generation in the United States going back to 1950. There was this long period where we were generating more, we were adding more electricity capacity. But over the last 20 years, that's been flat. Now, we've still been electrifying more, but we were just getting more efficient that overall demand needs were flat. Now, the problem is the last 20 years hasn't been a really exciting time for the companies along the grid to put really, expensive fixed capital investments to modernize the grid, even though we've known we've needed to modernize the grid. all of the sudden, in the last really 48 months, the economics around energy have really shifted. We're now looking at an acceleration of electricity demand growth of 2.5% each year for the rest of this decade. That owing to, on the right hand side, a doubling in the electricity consumption need from data centers, as well as plenty of other demands going on to the grid, such as the continued build out and uptake of electric vehicles, the Waymos that are starting to pop up in different cities, now in 7 cities in the United States. I, for one, have ridden in a Waymo in 3 of them already. It drove me over 30 minutes through San Francisco traffic. It was one of the smoothest rides I've ever been in. I took my dad in one in LA. If you're in a city where there's a Waymo, highly invite you to just give it a go. These cars have gotten far more advanced in recent years because of AI. It's a pretty smooth ride, and the data does show it. I digress. The continued advancement of electric vehicles, driverless cars, they're going to not be gas powered vehicles, right? And also these efforts around reshoring chip production. And even though we're not super optimistic that we're going to be able to do that quite quickly, as we do that incrementally, that is also adding pressures to the grid. So, what is all this going to take? This has been a key focus for policymakers, for the hyperscalers, and for the energy companies themselves. Because as we're looking at this steep curve when it comes to adoption, the build out and the construction of data centers is outpacing the build out and the timing of new energy supply. Now, we don't see that being a real big risk in the next few years, but we think 2028, 2029, 2030, there's some big questions. Can we get better efficiency gains to offset the increased need for energy? And what kind of energy sources can we tap into here? What we're seeing right now is a range of solutions coming to the front. Some of the coal-powered plants that were being retired, that's being paused. We are looking at increased production and supply of natural gas, but even then, that's going to take until the 2030s at large. Nuclear, absolutely a huge shift in policy focus around here. And nuclear could be really important, particularly for the big data centers that are training models and they need an always on, always ready source of renewable power. But even turning on dormant nuclear power plants, it's going to take a number of years, let alone getting new nuclear supply. We think that's 2030s onwards. And the reality is, even when we get that new supply, because of all of the waste and the regulatory requirements around this, it's still very expensive. So in the meantime, renewables, it's going to be a huge focus here, not only solar and wind, but just getting better and more efficient at using that energy. So a lot of different moving pieces there. Now, shifting gears a little bit, this infrastructure build out is also one with global focus here. So beyond the US, China is emerging as a really big player here. DeepSeek was this kind of eye-opening moment for a lot of us that China tech is actually maybe a force to be reckoned with. On the top left, you can see that gap in performance has been narrowing pretty significantly. Now, even though China tech is actually reached a pretty important threshold here, what is different is that the US is still pretty much the gatekeeper here when it comes to the usage of technology. ChatGPT, the most popular LLM, has an 81% market share globally. Pretty significant. But big questions as to how this evolves going forward, particularly as we get into the era of physical AI, robotics. In these Chinese cities right now, you can already order food via a similar DoorDash, and it comes to you by drone. You have robots helping with the staffing in restaurants, and you have these like Olympic games almost being conducted for their humanoid robots that are playing soccer. It's mind-boggling. But I think some big questions as to how that continues to evolve and the benefits or the beneficiaries in Asia supply chains that are all contributing to this. Okay, moving forward, how do we think about all of this in terms of portfolio positioning? And particularly, some of the risks that we have in the concentration to these tech leaders, in the shifting and the opportunity set. Well, it's hard to talk about AI leadership without talking about the Magnificent Seven. The last 2 years were years where the Magnificent Seven earned their nickname. Look at that. Pretty magnificent performance relative to the overall index. But this year has been one of dispersion. Only four, actually, yeah, four of the seven are even outperforming the S&P 500. And there's been a lot of movement in that over the course of this year. Now, what characterizes this? Well, part of the issue here is, as mighty as these companies are, and as I've talked about, the fundamentals are still quite solid. Valuations are elevated, and not only is it an issue of valuations, but investors already have a lot of exposure to not only the AI theme, but specifically to just a few individual companies. So the bar to increase exposure is pretty high. I like to say this is an issue of maybe we've all become like tiger parents to these Mag 7 companies. We've gotten used to the straight A's. Now we need A pluses and captain of the lacrosse team, summer internship, A's on participation. We want all of the above. And the bar to beating those expectations is that elevated. So that's one of the risks here for these companies, and maybe part of the reason why you're seeing this bubble rhetoric right now. It's just sometimes investors just emotionally get a little uneasy at just such a long stretch of remarkable performance. We do think it is important for investors to manage their exposure to just a small cohort of companies. And in that regards, we think looking elsewhere in public markets and also in private markets is going to be really important. So whether or not you're invested in private markets, it is a really important characteristic of this AI race that a lot of the innovation is happening in private markets. On the left-hand side, you can see the share of VC dollars going into AI. In the first quarter of this year, 71 cents of every dollar of VC money went into an AI company. Now, the biggest behemoths here have been some of these large language models, right? We looked at that list earlier. ChatGPT, Claude, Grok, those are all run and operated by private market companies. And it costs a lot of money, as we've talked about, to train models and service models. But in the year 2025, these behemoths can get all the capital they need in private markets, which is one pretty significant characteristic. Now, eventually, we'll probably get an IPO, but a lot of that growth that we're seeing right now happening in private markets. Beyond the LLMs, which we show here, what is also really gaining speed are these sector-specific AI applications. So when we were talking about enterprise adoption earlier, what is really key to getting enterprise adoption to scale and to deepen is AI applications that are customized to a business's need, to specific sectors, to specific use cases. And it's taken some time to get the proliferation of those AI applications, but we're seeing more and more of them. I mean, these are across legal AI, healthcare AI, manufacturing and logistics AI, marketing AI. Some are even going public this year. We're starting to see IPOs get some more life. Figma is one example. And so we expect to see more of this. And I think what's really remarkable about the current era of these small startup companies, they're reaching unprecedented scale in private markets. They're also reaching profitability metrics faster than we've ever seen before. It takes an AI startup on average just a year to get to $10 million in annual recurring revenue. And on average, it's taken startups 10 years to complete that historically. So a real pull forward in the timeline to profitability, or at least revenue generation. And I'll end here. I'm going a little over. Really excited to answer some of your questions here. But I think to kind of tie all of this in a bow, when it comes to investing in an AI world, I think a lot of us have gotten comfortable and familiar with the idea that AI is going to be transformative. It's had transformative impacts on our portfolios already. And I think the question is, how do we size this moving forward? And in that regard, we think diversification in the world in the era of AI, it's not just about risk management, but really a reflection of what an AI economy is going to look like. You have the compute providers in the middle here, the hyperscalers investing in AI infrastructure. That is flowing through to the bottom half of this page, to chips, to data centers, to power. But there are integrated and vast supply chains underneath each of those when it comes to the design, the production, the material sourcing of chips. the construction, the servers that go within these data centers, the cooling equipment that keeps them cool. And then power, not only in getting new power online, but getting power to where it needs to go, getting more efficient at using that power. And the companies involved in all of this build out, I mean, they span across utilities, industrials, materials, private infrastructure, public infrastructure. They're US, but they're also global. Emerging markets, Asia, really important for the chip supply chain here. If anything happens with Taiwan, that's going to be a real risk for markets. So some really interesting, I think, different flavors and trends here when thinking about the broadening of this AI value chain. And then, of course, the developers and the users of this technology. And for us, like all of this just really goes to emphasizing a few things. I mentioned diversification, but also active management. There is AI hype. There is AI euphoria. There are some individual companies that are trading at historically rich, pretty rich valuations. You want to make sure that your money is going towards AI investments that can separate hype from reality, hype from quality fundamentals. And then, of course, we also want to be humble. We don't know how AI is going to evolve in every kind of stretch of or corner of the economy and the markets. And so having and managing your exposure to any one individual company or any one individual trade is going to be really important as well. But with that, would love to open things up for some questions in these last few minutes here. And you can also, for more information, find more materials on our website. Also on my LinkedIn, I often am sharing some of my tidbits and thoughts on the AI landscape as it continues to evolve. But let me pass things over back to the host.
Thank you, Stephanie. That was great. We've had a couple questions come in around how we are specifically investing in AI-related industries or themes at Fraser Financial. And you mentioned words like diversification, humility, balance, and that's music to my ears, as you might imagine. But we are invested in so many different parts of the AI build-out. Most people might see NVIDIA or Meta or Amazon, and we own those stocks. But there's so much more going on that's not just those companies. So the robotics example, I know medical technology is something, Stephanie, that you talk about AI. We didn't have a slide on that today, but so many cool things happening in the medical industry that AI is enabling, whether it's research on genetics or molecules or new drugs. So many fascinating things going on there. But we own a Japanese robotics company called Fanuc that is benefiting from the advanced robotics. Data centers, I mean, if you live in Central Ohio, you've seen the massive build out of data centers. So just the equipment manufacturers, the companies that are making the heating and cooling units for those data centers, they make the building materials, even the paint that goes on the outside of the building. So you don't have to be chasing really high valuations in tech companies to benefit from the build out of AI. As far as picking stocks or picking investments using AI, that is not something that we do. There are some companies that have launched funds that have tried to do that. The biggest 4 funds that use AI to pick stocks have underperformed the market since inception. So asking AI to go out and pick your stocks and design your portfolio is just not something that it can do at this point. We're open-minded that it could at some point, but as of right now, we don't think that's a good use of AI technology. What country's economy is predicted to benefit the most from the AI race? I'll let Stephanie take a swing at that first.
Yeah. So it's a fascinating question. I mean, I will say, first and foremost, I mean, the US is at the forefront of a lot of not only the innovation around AI, the build out and the adoption of AI, but its head start, its leading advantage is narrowing a bit. And I think one of the more fascinating studies that I've seen recently came from OpenAI and Harvard, and they looked at ChatGPT queries globally over the last year. And actually, users in emerging markets, developing markets, were using AI more at a faster clip than those in developed markets. I think there's a lot of room here for the potential for some emerging markets to maybe leapfrog, to use AI quicker, to innovate. Some economies that already have kind of a digital services industry India kind of sticks out in that regard. But then I think more clearly you can see the benefits for companies involved in this supply chain. So in Asia, for instance, you have companies that are obviously incredibly important when it comes to the production of chips or some of the other components to chips. So, one example, high bandwidth memory chips. It's something that is needed specifically so that when we're asking, prompting these models, we get a response quickly, even if it's doing all of these layers of inference. And to do that, you need a specialized memory chip. And a significant moat in those memory chips is actually in South Korea. So there's a number of other examples like that. So I'd say there are some opportunities more broadly there. Obviously Taiwan, and then I mean China tech is something we're going to need to pay close attention to. And they have their own hyperscalers that are investing, and not to the same degree as the U.S. But they also have a more modern grid. So they may not run into the same kind of resource challenges as US companies may in the coming years. So a lot of, a lot of moving pieces there. But overall, I mean, look, even though China tech and some manufacturing has really shown its skill and competitiveness globally, no one really compares to the US when it comes to profitable innovation. So, in terms of the investment opportunities in AI, it's still, we think, more US centric story. It's just starting to fray at some of the edges.
And Stephanie, you probably agree with us that China probably has the best power infrastructure, and they've probably been a lot more thoughtful and impactful on how they're thinking about power generation. So that could be an advantage to China versus other countries.
And yep, it's one of those variables, those risks that we want to keep in mind.
I think they're building a hydroelectric dam so large that it's changing the speed at which the Earth rotates.
Yeah, it was like 3 millionths of a millisecond. The new dam that's bigger than Ganges Dam, they think slows our rotation and maybe the tilt. Like there were
Yeah.
two factors that changed in the Earth's orientation. Pretty wild.
Couple more great questions coming in. One around basically this enabling large companies to get larger. How does this leave smaller companies? That's a great question. We can hit on that as well. Regulatory environment, I think, is interesting. I think Europe has been more heavily handed in regulation on AI. There are laws being introduced now or thought. I guess all 50 states have AI related laws, I think, at the state level. There's an interview with Sam Altman and Tucker Carlson that's kind of fascinating if you want to watch that. There are some people saying that you need to start to upload an image of yourself and prove your identity to start using AI because they want to include maybe some non-child friendly areas of alternative investment. So I think regulatory could slow down, but the US has been very open to letting AI flourish, which we'll find out if that is a good thing or a bad thing in the long term. I know power, like Indianapolis, I believe recently voted to shut down maybe some data centers that were going to be built there. The electricity cost in Ohio has almost tripled in the last 5 years. So I think you will see growing regulatory pushback around deep fakes, maybe some of the things that AI is being used in nefarious ways. Stephanie, what do you think about the regulatory environment slowing down AI?
So that was a great overview. I mean, I think that's exactly it. As these use cases begin to proliferate more, we do think regulation will eventually come in, moderating, some of the riskier use cases here around identification, data privacy, and so forth. In energy, I think that's going to be a big potential issue. I mean, you're already seeing AI usage spike electricity prices in various different states, even particularly in the Northeast and in the PGIM. So if that continues, I mean, I think you're going to see just a broader social push against that. So we'll see. But otherwise, I will say this administration has been quite clear in its desire to not stifle the innovation and the progress around AI. I think, in fact, the regulation is much more around trying to, whether they're doing it the right way or not, but trying to protect that US moat, that leadership advantage, via export controls around chips, not sharing as much with China, and some of those other kind of data privacy laws that we're seeing.
AI superiority has become a national security interest, and you'll see the headlines of the US and China spatting over that. As Stephanie mentioned, the three most important companies are based in the Netherlands, which is ASML, and then you have Taiwan Semi in Taiwan, and then a bunch of US companies. And then we source a ton of the materials from China to build all these things. So we're all kind of intertwined. So it's a little tricky on how we navigate that. Looking at a few more questions, we got a lot of awesome ones coming in. One on AI index funds. Sometimes those are called like thematic funds. So investment companies will create an ETF or a mutual fund that's around a theme, which could be energy, could be AI. We're not big fans of those. I think those are better for trading vehicles. So people are trying to express some sort of short-term opinion on the markets. That's really not our style. So we would prefer to own those companies in a different format and not just try to own the entire industry, partly because so much of what is going on is not the first layer effect. It's usually the second or third layer that we think is where the most interesting opportunities are. Essentially, we think a lot of the good news is already in the price of the big tech companies, and the better, more interesting opportunities are in the second, third, or fourth layer of thinking around this idea.
There's also some big risks. Josh, you and I were looking at a list yesterday of AI thematic ETFs, and a lot of them were 20% NVIDIA. So there's a lot of risk that you could buy a fund that may appear diversified, and you're actually just buying quite a lot of a single company. So a lot to watch out for there.
I was trying to resist this bad pun, but the whole chips thing, like you don't have to go all in. You can win a lot of hands. It's not like poker where you have to put all your chips on the table, risk everything, and go boom or bust. You can collect a great rate of return without having to take too much risk. You knew I had to do it, Brian.
Yeah, that wasn't your best pun. You got to refine that one a little bit. Stephanie or Josh, you want to tackle? We have 2 or 3 different questions around energy, renewables versus current administration policy, and then another question around what market reforms would help supply all of this demand growth in AI. Maybe we can squish those into your broad thoughts around energy again.
Yeah. So, I will say, even though we're seeing the rollback of some of these subsidies around solar and wind, what is still true is that you have seen a lot of progress in declining costs for both. So even without the incremental fiscal incentives, it's still just the economics of it are still quite favorable. There's already like a lot of supply. They're like the quickest to add to the grid. I think the real bottleneck there is just a matter of the kind of the red tape around adding energy to the grid. So what can policy do? Reducing some of that, allowing just a faster process. Like some of this energy will stay idle for years before getting connected to the grid. So I think there's a lot of focus now from the administration around what they can do to expedite some of that process that will help. The other thing that's helping is battery technologies. So the incentives around that are actually not stripped from this administration. And batteries are going to be also really important when it comes to trying to use the renewable power all year round and getting more efficient at using it too. So we're still quite early, we think, in the build out and the proliferation of battery technologies across the grid. So I think we're going to start to see a bit more of that. But at the end, the challenge ultimately at the end of the day is, even if we had all of that power, renewable power, it's still not enough for AI. So you're still going to need some of these other solutions to come in and fill the gaps.
There's one more question I did want to field. But on the power side, Stephanie, I don't know if you've heard this, but nuclear build out, obviously people are excited about that. It's been talked about for a long time. Natural disaster in Japan years ago kind of set back some of the momentum there. But I think we're as a society getting warmer to the idea that we need that as one of our power solutions. What I hear from the data center build outs and other tech investors is that they want the nuclear technology to work. They are investing in it. However, if they need to get power generation up and running in the next 18 months, solar is probably one of the only ways they can do that. And it may not be the most cost-effective, long-term energy solution, it does get their equipment up and running in a short amount of time, which is valuable to them. All right, last question. AI, is it locking out small investors, small companies? Is it going to become a monopolistic technology? From what I think, I've got a pretty optimistic spin on this, Stephanie, so you can maybe temper me a little bit. But if you think about AI more of like electricity or the internet, it's basically a general purpose technology that everybody can benefit from. And when Stephanie was going through those slides, you saw all the different companies that have amazing AI tools, and they're all very competitive, and the switching costs are really low. So if I want to stop using ChatGPT, start using Claude, that could be one of the easiest tech switches that exists versus an operating system on a computer or some other tech related investment. So I think the switching costs within the AI are really low, so it's very competitive. And if you think of like a firm like us, we use a special purpose AI tool called Tax GPT, which is basically the equivalent of having a tax research tool that is as good as maybe the best tax lawyers at the fanciest law firm or tax firm ever. But we have that for $100 a month, and we get to use it all the time for our tax research. Preparing for this call and all sorts of other things, I'm using AI tools to help me get my ideas and thoughts organized. I essentially have like 15 assistants that are doing research for me, and I pay $20 a month. So I think there's a lot of areas of AI that will actually democratize information and opportunity. Stephanie, I'll give you the last word on that.
Oh, I think I absolutely agree. I mean, there are some questions of, the bigger getting bigger because they are kind of the fastest when it comes to integrating AI and seem to be, if they're, all of their bets kind of pan out, really at the forefront of all this AI demand that's coming. But I do think, kind of similar to what we're seeing just in the adoption data right now, there is so much that smaller players, smaller economies, individuals have to gain from using this technology. I think there will still be a lot of dispersion underneath the hood. And then ultimately, I mean, productivity is in the long run, it's kind of everything. It increases standards of living. It increases wages. And I think there'll be a lot of fruits to go around. I mean, who knows the distribution of that exactly? But we think there's a lot of opportunity in the middle there. But
Well, thank you, Stephanie. That was awesome. We appreciate it. Thank you to our clients too. We always get so many amazing questions. I think people are usually taken back by all the great questions that everybody asks. So love that. Love how engaged everybody is. We're going to keep doing these. They've been very popular. So stay tuned. Check your email boxes for signups for the next one. Stephanie, happy Friday and thank you.
Thanks so much.
Thanks, Stephanie.